Peter, can we sit on the UK just for a moment? It's a bizarre moment. The Chancellor's trying to offset the pain for energy prices. The Bank of England's whacking up interest rates by 25 basis points and maybe more down the road, Peter. What's your take on all of this?
Well, as you say, it's not an unexpected move, but it's a necessary move given the rise in inflation, both core and headline, and also the significant tightness in the labour market. And as you said, there are similarities here with the US, and so I think markets will be watching very closely what the reaction is in the market. But it is a difficult decision because while you're seeing these higher inflation pressures, at the same time the cost of living is going up. You've just seen a big rise in energy prices.
Peter, that's okay. You can put David on hold. Okay, you can put David on hold. It's not a big deal. Continue.
Well, thank you very much. I'll mention that. But there's a squeeze in energy prices just coming through, and of course there's also an increase in national insurance taxes. So this will affect consumers as well. So it's a very difficult balance, but in the end, the economy is robust enough, I think, to withstand the effect of rising rates away from what really have been emergency levels. And I think, as you say, this really is a situation which all central banks are now facing. Is it still appropriate, given inflationary pressures, to keep interest rates at what were, after all, emergency levels in the face of the pandemic?
So we're at 50 basis points right now. Traders in the market, just in terms of market pricing, we're pulling forward the 1% line in the sand to May. Peter, just for people in the United States and outside of the UK, can you just walk us through on how important bank rate is at the Bank of England, how quickly things just kick in? They make a move and the banks follow almost immediately.
They do, absolutely. So, it will have effect on borrowing rates. Remember also that mortgage rates in the UK, while a large proportion are fixed, unusually relative to other countries. They don't tend to be fixed for very long periods of time. 2 to 5 years are quite common. And so you will gradually start to get this squeezing through into, bank lending rates and to the broader economy.
Sterling 136.11 right now, a little bit of sterling strength this morning. Peter, we're so honored to have you here. Peter holds one of the most prestigious undergraduate degrees in the world with first-class honors, a geography degree at the London School of Economics. Peter, I want to go all Lionel Robbins on you. This moment seems like we did the pandemic and the financial bigwigs won and a lot of other people lost. How do central bankers across your geography, the ECB, the Bank of England, the Fed, and all the other central banks, how do they get us out of this, extract us out of these excesses and provide stability at the same time?
Well, I think that the first thing we should recognize is that the economies are recovering. And despite, the obvious panic, given the speed of the adjustment in rate expectations, we're looking at global growth this year to be about 4.3%. That's still about a percentage point higher than the long-term trend. So you have to think in the context of that and facing some important inflationary pressures that gradually increasing rates, at least to a level from which they could be cut again at some future point, does make some sense. And I think that in some ways, the central banks would be quite happy with the reaction that we've seen so far. It hasn't been a panic. Remember, as recently as June of last year, the consensus was looking for no rate rises, for example, in the US this year, and perhaps one at the end of next year. We're now seeing a whole sequence of rate rises that have been priced in. And risk assets are holding up. There's nothing that's systemically problematic at the moment. So it's gradually weaning, I think, economies off of zero interest rates in a period of reasonable growth but higher inflation that I think makes sense, and we'll probably see more of it.
Peter, it makes sense, and the issue is how you trade around it, and you've been talking about the value trade, yet I'm struggling with financials at a time when each rate hike is met with more yield curve flattening, and we have seen it in the US, in the UK, and throughout the Euro region.
Firstly, I should say we have been recommending a focus on value. We think that in a more inflationary and a reasonable growth environment, many of these areas do look more attractive, particularly in the energy space. But we've liked banks as well. And you're right that a flattening yield curve is not ideal. On the other hand, any rise in rates, particularly across the European region, where they've been extraordinarily low, in the euro area still negative, would be quite helpful for the banks, so long as the economies remain robust. I think the time to be worrying about that sector is when you really would get a rollover in growth as a result of higher rates. And we're not in that phase yet. In fact, across Europe, we're quite optimistic of growth. We've got UK growth this year at around 4.5%. Compared to about 3.2 in the US. We're looking at over 4% growth in the Eurozone. So I think given that growth, the banks will still be able to absorb flatter yield curves in an environment where short rates are rising.
Peter, I would not mention individual securities, but you do mention Amazon in your research note as something beleaguered and downtrodden. What does Goldman Sachs say about Amazon this afternoon?
Well, I think I would want to make a distinction between, unprofitable tech companies, and we have a basket of those which have fallen very, very significantly as interest rate expectations have increased, and other growth areas of the market that are profitable with strong balance sheets and are cash generative and weren't that expensive to begin with. I can't comment on a particular company,
Sure.
But I think that we are starting to see some growth areas of the market also coming back to levels which look reasonably attractive given still quite solid fundamentals. So our view is that while we've liked value, we don't want to be only in value. There are certain areas of growth which make sense to mix with these deep value areas. And in that sense, I think this combination of factors will continue to dominate in a way that we didn't see in the last cycle, which was very, very much focused on just one factor, and that was growth alone.